RecShare's new ETFs. How have they done since inception? We're going to find out today.
Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. And today we're talking RecShares. And RecShares has quietly rolled out a new lineup of income-focused ETFs. And you've probably seen the yields and stopped scrolling and said, whoa, are these things serious? And the big yields don't always tell the full story, as you know. And one of the real questions, and it's very simple, how are these funds actually performing since inception? So today we're breaking down the 5 funds that came out, and we're going to take a deep look into it, how they generate their income, what has their performance been so early in their stages, and really give you an insight of, are these worth investing to? I think I found 2 of them that are very, very strong that I'm going to probably put in one of my portfolios. But we're going to talk about that in just a little bit. Let's get into today's video.
Guys, so important notice to everybody, this presentation was designed and provided to you by an educational purposes only and it's not constituted financial advice. Educational purpose, no financial advice, distributions are not guaranteed, the yields are subject to change without notice, and if you need any professional help, if you need questions on the financial stuff, always contact a financial professional. Don't just watch a YouTube video. Don't just ask someone who sounds like they're intelligent with it. Always ask a professional first. So I want to make sure everyone understands that this is not a recommendation. We are not going to sit here and give you a recommendation of a particular fund or one to buy or not to buy. These funds are all very new, which means limited history, involving distributions and strategies that investors must understand before focusing in on yield. And as you know on this channel, we are not focused on yield, we're focused on total returns. We're looking for strategy design, income mechanics, early NAV behavior, and what's encouraging and what deserves caution. So we start off with, if you're not familiar with, who is RecShares? Well, RecShares specializes in rule-based, option-driven ETFs, often targeted through income through derivatives, structured exposure, or thematic overlays. The new funds fall into the category of the high-income, non-traditional ETFs, which means performance depends heavily on the strategy execution than simple market direction. So with these funds falling into their growth in incomes, called their balanced growth and income strategy, what RecShare does is they take the portfolio and half of the portfolio is set to generate weekly income via covered call strategy. And they use an enhanced exposure with a targeted 1.25 leverage on those funds. And that leverage that they'll talk about is really providing between that 1.05 and 1.50 exposure to the underlying asset or equities of that particular fund. Now, the other half of the fund remains uncovered, allowing for uncapped upside potential. Because with a covered call strategy, you are capping out your growth. You are capping out how fast or how quickly you can grow a fund because you're generating income. And this is what makes RecShare so special, is that they use that balance, 50-50 blend between the two. We've covered this many times in our videos that we've done. So I personally like the philosophy. I like their strategy. Does it always work? Well, it really comes down to that underlying asset and how well will it do in the marketplace. So let's take a look at the very first one, and that's going to be HOII, which is their Robinhood Growth and Income Fund. Now, this fund here, as we know that Robinhood, the underlying, has struggled lately. It is heavily debated with crypto. So it's a major crypto market, and as crypto had its drops and had its falls, Robinhood has done the same. But HOII is designed to generate income primarily through options-based strategies layered on top of its underlying exposure, which is Robinhood. Early on, the distributions have been eye-catching, and what matters more is the NAV stability. When we look at the board, you can see the early income was strong. They're showing a distribution rate or a yield at 24.78%. Their NAV is right around 17.18, so $17.8. You can see the fund is actually below its NAV. And the total return that we really concentrate on is a negative 22.45%. Now, of course, this fund is new. It came out on November 4th. So really we had the month of November, of December, and here we are just halfway through January. So 2.5 months so far. This one writes out of the money call options on Robinhood using synthetic exposure to capture that premium income. So again, the income was strong, but unstable NAV is what we found so far with the package. Assets about 1.2 million, about 70,000 shares. So they haven't really gotten their foothold. They really haven't gotten the grip that people need in an ETF to really make this thing run. Very similar we've seen with all of the Rec Shares programs until people start seeing it down the road, which I love to hear. And that is 6 months into a fund before you really start making decisions, because you got to see where the fund's operating. So let's dig a little deeper. Again, what we did is we put this up against the Robinhood itself and HOII to give you a better comparison. And the unique thing that I found with this is look at the blue line, which is the HOII, the Rec Shares. And you'll see that has followed almost to a T what happens with Robinhood. So when it drops, they drop. When they go up, they go up. All the way through. Now here's the big difference though. Even with that leverage, they are not getting the upside. That's the cap. The half part that's capped, I think, is causing most of their issues. Of course, it's going to generate your income, but it's holding it back from beating Robinhood in the all-out race. So if you follow the track and know that this fund is going to follow what Robinhood does and will not climb above Robinhood, as long as you're generating the big income is great. But as long as the income is coming and the NAV is not, and this is really where you're seeing the drop off, Robinhood had negative 18.94% over the past 3 months, while HOII is down 22.45%. That's the NAV work. That's the leverage working in reverse. So it's not capturing any real piece of the puzzle. There's about 4% difference between the two. So this one, I'm just telling you, it's something that you have to investigate. You have to look, and you have to let the fund run a longer period of time. Our next one is going to be PLTI, the Pelter Rec Shares Growth and Income Fund. Now on this fund here, again, this one writes those out-of-money calls on the Pelter stock. It uses synthetic exposure to capture the premium income. Distribution started off, they're showing right now, reporting from Rec Shares, that they're looking at 19.8% running numbers of their distributions. Their NAV, $19.49, so we're down about 12 cents below. So not as bad as you would think, but the total return is down 10.03%. So the fund definitely is, it's struggling. 1.41 million, 70,000 shares outstanding. Again, this one came out on November 4th of 2025. So the number of shares between Robinhood and Pelter are virtually about the same. Assets under management fairly close to each other. So again, it's one of these segments that has not really amplified, hasn't turned on many investors. It's kind of been quiet. This is why we wanted to put this out there and just see, is this thing really working or not working? I believe we're at strike two, my opinion only. So all I'm saying is my opinion, and I'm just a regular retail investor as everyone else. I don't think this one's working as well as I've seen the system work before. When we take a look at the underlying stock, the Pelter versus the Rex Shares program, you can see again they are following the underlying asset extremely well. Except look at the difference. There's a 6% drop off, and to be safe, I'm going to say more of a 5. We're going to give it 5 and the eighth difference, 5% difference between the two. Partially, that can be the NAV. Okay, excuse me, that can be the leverage that is causing that it can't raise, and the capping can't raise. But the underlying stock is not doing as well either. You can look since this fund came out at the very beginning, where the brown and blue lines start off at. You can see that Pelter has never really gotten above very high. It's been struggling trying to get its footing moving again. So we're fighting between the two. They are following exactly what's going on. So if you have a raise, you're going to have a raise, but you're capped. If you're having a drop, and you're going to have a bigger drop because of the leverage that's being used. So again, following tooth for tooth, but still not the piece of the puzzle that we're expecting. More time to let it cook. Our next one, CWII. This is going to be the Rex Shares Core Weaver setup. Now, Core Weaver has been an interesting piece. I will tell you this. I've been doing a lot of research and a lot of looking at Core Weaver that I think part of the AI package and what they're getting into is going to bring some attention to Core Weaver. So the CIW introduces the more concentrated risk, but cuts both ways. When the strategy works, income looks excellent. When the volatility spikes, the NAV responds quickly. So again, early signs, the income was strong but uneven. The NAV was more volatile, and the higher risk for those income seekers, this one was kind of doing what it was doing. But I want to tell everybody that CWI is not pretending to be a conservative fund. This fund is where you need to understand distribution sources and matters more than the headline yield that they put out there. Where are they getting their sources from? And this fund, again, the strong initial returns, they were looking at originally year-to-date numbers around 35.62% total returns. But, again, we've had some volatility across the board. The fund came out November 4th. You can see the distributions are rated out at 33.03%. The NAV at 16.81. You can see the current price of the fund that they have doing this video is down to 15.59. The total return is down 21.56. This one has not even broke $1 million under asset yet. There's only about 50,000 shares that was introduced. So this is the slowest one of the first 3 funds. It's really been slow grasping any traction. And, when they caught some attention with that big distributions at first, but we're seeing a big holdback on this. Now, the other thing I see is this thing is that Core Weaver, that they have put almost 41% of the Core Weaver stock into the portfolio. And that's an interesting piece that they're putting, heavily into it. A lot of these funds are putting most, like 90% of their money into cash, and then doing those synthetic covers and the synthetic swaps and so on. So they're not really investing into the stocks. But these guys here and this one here, they're kind of putting their money on that 40% of the portfolio. Now, when we look at the underlying, this is where it starts to get you interested. This is where it starts turning the tables a little bit. In the past 3 months, the core Weaver is down 27.30%, while the RecShare CWII is actually only down 21.56%. Now, I know we're talking negative numbers, and none of us ever want to talk negative numbers. But what it tells me here is that it's beating the underlying stock. It's beating the core Weaver. So as core Weaver starts to take off and recover, which we're seeing here at the last few couple days, that the CWII, what they're doing, their strategy they're using, is actually growing faster than the underlying asset. So this means this is a potential buy-in that could really help the fund down the road, giving it more distribution and then recovering itself. So this is one, again, I'm putting a kind of a watch on this one because I want to see if this continues in its trend, that it could be a nice possible pickup for a short-term distribution side of things. Now, our next fund we're going to talk about is Eli Lilly, the LLII fund. Now, this one brings an additional complexity, either through the enhanced exposure, the leverage-like behavior, or the aggressive option overlays that they're using. We're seeing some very attractive yield so far, 24.90%. And we're seeing some sensitive to the market swings. This is the first fund out of all these new ones. And again, came out November 4th. But this one actually has had a 9.44% growth so far, which has got the attention. If I'm having distribution yield and I'm getting additional growth, we should have some positive total returns. The $1.9 million under assets, looking good. 70,000 shares outstanding, about par with the first three. Distributions have been, like I said, fairly consistent and fairly solid, so definitely a potential good payout type fund. Now, this one here, LLI, is a type of fund that works best when used intentionally and not accidentally. Positioning size matters here. And what do I mean by that? You need to make sure that you have the proper amount of positioning of the fund and having it work correctly in this healthcare marketplace. When we look at it, this goes back to what we were talking about. The capping is hurting it because of Lilly is up 25.81%, while LLI is only total return up 15.19%. So there's about a 10.7% gap between the two. It is following the underlying stock, which I'm very proud of, very excited about. And I like the positive upswing. But with the total return so far, that it's mostly going to be, it's in the growth side of it, with a small part of it coming from dividends currently, but long-term projections are saying we're at 24%. So we look at this fund and say it's below, which is the capping, which is that call options causing it. But at the same time, it's matching tooth for tooth. So if Eli Lilly goes up 50%, this one would probably be up 30%. So it's a positive factor between the two. And this is one of those I'm going to, the first one of all, that is actually I'm putting heavily on my watch list of very quickly and very potentially that this could be my future into a weekly payer for the healthcare side of it. So I'm not really as concerned about the underlying as much as it's following it to a T. It's going to give me the capping is what's doing it. I'm hoping that the leverage would do more with it to make up for that difference. And that's what we're concerned with. Now our final one is going to be the Walmart plan. And when I first heard this one come out, I was excited because Walmart, no one else has an ETF with Walmart doing it on a single fund. And I was like, this thing could be interesting. So WMTI appears to be the most measured of the five, and the income generation that prioritizes stability over max amount payout. So income consistency has been slowly improving, and the NAV erosion is less pronounced than any other fund that we've seen, and the strategy clearly is higher across the board. If one fund in this lineup eventually becomes a core income satellite, WMT may have the best structural foundation, but time will tell, of course, because they're so new. This one came out November 4th again. Look at the fund so far. When it came out, it started to move and continued to move. It's up over 10.86%. Their distribution, 17.86%. Now remember, none of the distributions are guaranteed. And this is why I always say yield is not something that you want to chase, because that 17.86 will change as the price of the fund goes up or goes down, changes the yield that quickly. So that's why you never want to chase a yield. You want to look at total returns, what's happening, and where's it going from here. Now, 1.97 million in assets, probably the largest one out of the five. 70,000 shares. So you can see that these things are all brand new. They have not issued a ton of shares out of them yet. And we're seeing more volume than we've seen in other funds. So kind of a positive type situation. Now, this is what got me the most excited, and I will tell you, this is the number one fund that I would be investing into me personally, because A, I love Walmart, and I love that I have a fund that can deal with it and generate some nice income through it. There's just so many positive about it. Now, that's me personally. I've already done my legwork. You need to do your research. You need to do your legwork to find out, does this fit your portfolio and fit your risk tolerance? But look at what's happening here. Again, everything I've showed you, and this is almost like the reverse now. The leverage is actually working very, very well. The lines match each other perfectly. Okay, so when Walmart makes a move, the fund makes a move. When the Walmart makes a drop, this is going to drop. But we are up over 6.7% above Walmart's trending total return. And yes, this is over the past 3 months. So this is how long the fund's been alive. So when we're looking at this, you got that 6%. That's leverage helping you get ahead. That's moving you forward. And that's a lot because, on one hand, leverage is helping, which generates that income, but also that natural uncapped is creating the additional that we're starting to see. So now we're taking a look too, but the Walmart one, I found them doing a little more research to it and found out that this is the most defensive option that the RecShares has in their portfolio. It's a conservative approach because it prioritizes the consistency of income and the NAV preservation. So they're trying to do your capital preservation. It's focused on that capital stability. So that income consistency, they're trying to get that 17.86% with improving, and the NAV, minimal NAV erosion at all compared to other funds. And when you look at the total return, you can definitely see the increases to it. The strategy clarity is very clear. And one of the things that is going to throw you for a little bit here is the allocation that they've done to treasury bills. In the fund, 89% of the money that they have into it is into treasury bills or cash equivalents. So it's really only holding, what is that number going to be? 11%, 12% in other holdings that is generating the income. So that's what keeps that NAV a little more stable with what's going on. And the holding strategy and the holdings and the strategy is very clear that they do. 89% in the U.S. Treasury bills, 18.8% is in calls. First obligations 1.27. So you can see what they're doing here. They're putting their majority of their funds into the treasury notes to collect the interest, but then they're doing those covered calls on a small portion of the portfolio. So the conservative asset allocation, the limited derivatives, so the minimal synthetic exposure compared to other funds in the lineup, the income stability and the transparency that they're doing makes this fund so easy to follow and so easy to understand, and that it follows the Walmart to a T. And as being one of the largest retailers in America and really globally starting, they have that potential of continuously growing their marketplace. So let's take a look at a summary of the funds across the board. We can do a nice comparison. You look at the first three, HOII, PLTI, CWII, great yields. Trust me, great yields. But that NAV and that growth side of it is way out of whack. It's just way out and giving you negative big number total returns. So starting with how you got high income but unstable NAV. You have the Pelter, which is balanced income, but again, NAV issues. The Core Weaver, I really think that one's going to have that strong income. It's going to continue, but they got to fix the volatility of the NAV right now. And really the two funds that fit in my key points and that I won, LLII, I'm watching. It's too new for me to buy. It's too new for me to be an investor into it. I'm going to take a look at. Has attractive yields at almost 25%. And it has the elevated risk to it and has a nice growth to it. So a 15.19% total return. And then the Walmart one, which is, I'll tell you, it's that consistent income and the stable NAV and the defensive move that I've liked since the day I saw that fund come out. So I don't own any of these. I'm sitting on the sidelines waiting because my rule of thumb is always 3 to 6 months before a fund gets active. That's why I decided to do the video since we're getting close to 3 months. And you can see everything comes out in the wash. I think Walmart's showing to be the best out of the 5 new funds at this point in time. And it's really taught me something here. Strategy matters. The strategy that they're using, you would think is the same over and over and over, but they're not. They're doing different things with it. And the Walmart shows the difference in that strategy. And that income first, when that arrives, the NAV behavior tells the real true story, what's going on. So early stage patterns, we see what's happening. We see how they're all matching the underlying stock. So you have to first off say, is the underlying stock worth investing into? And then moving on. And again, Walmart fits that bill fairly well. Again, not a recommendation, not telling you this is what to buy. It's just the numbers on the board tell you where we're looking, where we're heading, and where down the road I think we'll be. So my two strong ones, the defensive mode of Walmart at 17.86% yield, is got that income consistency, the low NAV erosion, and the strategy was very clear to me is that they're putting a lot of the money, majority of the money, into safety harbor and using the synthetic on a smaller portion, about 20% of the fund, into those synthetic mixes. Nice total return at 16.79, and again on the board, look at the overall total return of Walmart versus Walmart. Very strong. Now aggressive, Eli Lilly is definitely aggressive. It's cranking out the yield, and it's had some success, but it is underperforming the underlying asset, but still generating big yield and protecting our NAV. So is that one a future? If it continues on, yes, that's what I'll be saying. Yes, I will probably be purchasing into it strictly because it's something new and different I've never had. I like both of them. One defensive, one aggressive. And for my rec shares portfolio, it could be a nice mix between the two. So the key things that I'm monitoring and the metrics that we always need to do, the critical measures track for the next 6 to 12 months to access the stability of the income, I've always said you wait 6 months before you invest in a fund. Some I'll say 3, but most of the time it's 6 to 12. Distributions. Is it sustainable? Is income supported by actual generating, or is the NAV eroding? And some of the funds, it's holding well. Other ones were failed. NAV versus distributions. And again, some were good, some were horrible with the NAV on that whole lineup. I really only see 2 funds that were anything worthwhile. And then the payouts and the volatility both. All of them followed the underlying asset very well, but did not produce the way that we wanted the funds to be. So what should investors watch for next? Well, it's pretty much the same thing. You want to watch that distributions, you want to watch the NAV, you want to watch the payouts, you want to watch the volatility. So REX shares